President Trump's second term was marked by an explosive tariff policy, the consequences of which reverberated throughout the global economy and politics. Are trade wars inevitable? On February 4, 2025, the Trump administration launched a series of measures that shook global trade, a 25% tariff on imports from Mexico and Canada and an additional 10% tariff on goods from China. These steps, designed to correct trade imbalances and strengthen national security, drew immediate and sharp criticism from affected trading partners. Less than 2 weeks later, on February 13, the Fair and Reciprocal Plan was unveiled, aimed at countering non-reciprocal trade practices by countries such as Brazil, India, and the European Union. The plan highlighted inconsistencies in tariff structures and trade barriers, portraying the United States as a champion of fair trade. Tensions reached a boiling point by February 27 when President Trump announced an additional 10% tariff on all Chinese imports, accusing China of failing to stem the flow of fentanyl into the United States. This measure was scheduled to take effect on March 4, marking another turn in the already complex trade relationship between the two countries. The very next day, February 28, the administration demonstrated its willingness to further strengthen its protectionist policies, announcing the possibility of introducing new tariffs on the European Union and a number of other key trading partners. Amid growing anxiety in American business circles and among economic experts, on March 3, the White House made an unexpected maneuver. President Trump issued an executive order suspending some of the newly introduced tariffs on certain goods imported from Mexico and Canada. This move was seen by many as an attempt to calm markets and mitigate potential negative consequences for the domestic economy. However, on March 4, despite hopes to the contrary, the 10% tariff on Chinese goods came into effect. The reaction from Beijing was immediate, with retaliatory duties of up to 15% imposed on agricultural products imported from the United States. The escalation further exacerbated trade tensions, placing American farmers and exporters in an extremely vulnerable position. The economic consequences were not long in coming. The beginning of March was marked by a noticeable drop in the Dow Jones Industrial Average, which lost more than 300 points in just 2 days. This reflected growing anxiety in the investment community, concerned about the unpredictability of the current administration's trade policy and the general uncertainty in global markets. Despite signs of economic turbulence, President Trump demonstrated unwavering confidence in his chosen tariff strategy. On March 8, a statement was made about the possibility of introducing retaliatory measures against Canadian dairy products and lumber, citing unfair trade practices and high tariffs imposed by Canada on American exporters. Such statements only exacerbated tensions in trade relations between the two neighboring countries. The administration's chaotic and sometimes contradictory tariff policy created an atmosphere of instability, causing frustration among businesses, investors, and international partners. The endless cycles of imposing, suspending, and reimposing tariffs led to increased market volatility, exacerbated the trade war with China, and intensified domestic criticism of Trump's economic policies. Ultimately, this strategy played a decisive role in shaping the political landscape and had a profound impact on the economic trajectory of his second presidential term. The U.S. dollar weakened significantly, causing concern in financial circles. Many analysts directly attribute this decline to the unpredictable tariff policy of the Trump administration. Disorienting policy changes, sudden announcements, and unexpected twists in trade relations destabilized global markets, prompting investors to shed dollar assets. Instead of fulfilling its traditional role as a safe haven for capital, the American currency found itself burdened by trade tensions that it had created itself. This report focuses on the accelerated depreciation of the dollar and its implications for stocks, commodities, and investor sentiment. It examines how tariffs imposed on both allies and trading partners have undermined economic stability and accelerated the dollar's decline. In conclusion, expert opinions will be presented and possible policy adjustments will be suggested to highlight the measures needed to restore confidence in the American currency. The Trump administration's trade policy, bordering on open confrontation, caused noticeable nervousness in the markets, which was immediately reflected in the position of the American currency. The U.S. dollar has appeared to lose its former confidence, retreating to multi-month lows. The dollar index, which closely reflects its value against a basket of key global currencies, has shown a decrease of approximately 5% from its January peak values, with the majority of losses occurring in recent weeks. Once supported by favorable economic indicators and hopes for moderate Federal Reserve policies, the dollar now struggles with concerns that the introduction of tariffs could slow economic growth in the United States. Against this backdrop, the euro has triumphantly asserted itself, strengthening by about 3% in just a few days and reaching a mark of approximately $1.70. Disappointment in the U.S. trade strategy, combined with improved economic prospects in Europe, has fundamentally changed the sentiment that previously favored the American currency. The fall in the dollar index became particularly noticeable in late February when it plummeted by more than 1% in a single day. This sharp decline was triggered by traders hastily closing their long dollar positions in response to the ongoing uncertainty regarding tariffs. Currency markets in developing countries have experienced mixed dynamics against the U.S. dollar. Following the introduction of new American tariffs, the Canadian dollar and the Mexican peso experienced a sharp drop, reflecting investors' concerns about the prospects of North American trade. At the same time, the Japanese yen, traditionally perceived as a safe haven, strengthened its position amid stock market sell-offs, indicating investors fleeing from American assets. Overall, the weakening dollar has become a clear confirmation that the Trump administration's trade initiatives, contrary to expectations, have not strengthened but rather undermined confidence in the U.S. economic outlook. Analysts note that long positions in the dollar have lost their appeal as the White House's unpredictable tactics have raised concerns about deeper political turmoil. The S&P 500 index experienced one of its sharpest one-day declines this year after the presidential administration dashed hopes for a softening of tariff policies toward Canada and Mexico. Investors fear that an escalating trade war could lead to reduced corporate profits, disrupted supply chains, and weakened global demand. Market volatility, closely tracked by the VIX index, serves as a vivid testament to how quickly tariff battles can collapse stock markets. This unpredictable cycle of statements and counterstatements only multiplies uncertainty, painfully affecting both American and foreign stocks. Amid market turbulence, there is a noticeable inflow of capital into traditional safe havens, such as gold. The precious metal has reached record highs as investors try to assess the risks associated with escalating tariffs and a weakening dollar. U.S. Treasury bonds, which usually benefit from such a flight to quality, have not shown the expected dynamics this time. Their yield has not decreased as significantly, which, according to many analysts, reflects concerns about stagflation, a phenomenon in which price increases are accompanied by slowing economic growth. And the catalyst for this process is precisely the tariffs. Inconsistent policies in the style of a tariff a week have created chaos in commodity markets. Oil prices fluctuate with unpredictable amplitude, falling sharply each time tariff wars threaten to undermine global economic activity. Thus, during one of the most turbulent weeks, prices for WTI and Brent crude oil fell by 3 to 5% as traders feared a decrease in demand for energy. Amid the tariff battles unleashed by the new trade policy, some industrial goods have experienced a price spike caused by an artificial supply shortage. However, the overall atmosphere in business circles remains wary. Manufacturers and shippers around the world, as if in a fog, are trying to figure out the next move of political strategists. Perhaps the most devastating consequence of tariff unpredictability has been the undermining of trust in the business and investment community. Analysts at leading banks note that until recently the United States, like a magnet, attracted capital from all over the world. But now, as tariff barriers rise and negotiations are mired in contradictions, investors are turning their eyes elsewhere. Public opinion polls indicate that many companies are postponing decisions about hiring new employees and making capital investments, simply unable to predict whether a 10% or 25% tariff will be in effect on one or another type of import in the next quarter. This wait-and-see approach is putting noticeable pressure on economic growth, which, in turn, cannot fail to affect the national currency's exchange rate. In an unprecedented departure from years of tradition, the previous administration extended punitive tariffs even to key allies, causing a bombshell effect in financial markets. Amid a whirlwind of declared ambitious goals, the closest neighbors and long-standing economic partners of the United States, Canada, and Mexico found themselves caught in the crosshairs, bound by the North American Free Trade Agreement, NAFTA, now known as USMCA. Such steps not only provoked an immediate backlash but also seriously undermined faith in the stability and predictability of American policy, especially among those who had come to regard themselves as reliable partners. The imposition of 25% tariffs on imports from Canada and Mexico sparked outrage and fueled fears of a protracted trade conflict erupting on America's doorstep. While the White House was quick to announce temporary exclusions, the overall tone remained defiantly unfriendly. The decision to double down in the game with China, raising tariffs on Chinese goods from 10% to 20%, spurred a new round of retaliatory measures, thereby prolonging a dispute that had already begun to significantly impact global economic growth. In late February, threats were made to introduce even more sweeping measures, so-called reciprocal fees against a number of countries, including even U.S. allies in Asia, if they failed to meet some vague requirements. Adding fuel to the fire of market anxiety, the administration demonstrated an on-again, off-again approach with tariff suspensions and cancellations following each other with dizzying speed. This inconsistency left businesses scrambling to plan their logistics and assess future costs. The political turbulence of recent years has left a deep mark, increasing the perception of instability and making the American currency particularly vulnerable to fluctuations. An aggressive stance toward allies and key trading partners has undermined confidence in the United States as a reliable leader, which has inevitably affected the prospects of the dollar. Retaliatory tariffs imposed by the affected countries only exacerbate the situation, creating a vicious cycle of escalating tensions that puts pressure on the dollar. Recent economic data from the United States indicate that the manufacturing sector is struggling, reflecting rising raw material prices and supply chain disruptions. The ISM Manufacturing Index in February recorded a slowdown in growth, with some components even showing contraction. Many companies are explicitly stating that tariffs have become a serious problem, hindering their development. The Federal Reserve's Beige Book confirms these concerns, noting that uncertainty regarding trade policy is negatively impacting economic growth. The international arena is no less alarming. The World Bank and the International Monetary Fund are expressing serious concern that ongoing trade disputes could slow global economic activity, creating additional risks for the world economy. The global economy, already weakened by years of geopolitical tensions, faces new challenges. The reduction in trade volumes is painfully affecting countries whose well-being directly depends on export operations. The unpredictable policies of the United States of America add further nervousness to the investment climate. Economic experts increasingly point to the unpredictability of the Trump administration's trade policy as the most destructive factor. In an environment where tariff rates can skyrocket overnight, business is frozen in anticipation. No company is willing to risk resources if another tweet from the White House can negate all plans. Such an atmosphere of uncertainty is detrimental to business expansion, research and development, and the creation of new jobs, key elements of economic stability and growth. Returning to economic realities, it is worth noting that tariffs, like invisible webs, ensnare consumers, driving up prices for imported goods and raw materials. Inflation, like a fickle wind, sometimes subsides and sometimes intensifies, but households are already feeling its breath in the form of increased costs for electronics and household appliances. If economic growth slows down amid continued price increases, the Federal Reserve may face a difficult choice. Investors, in turn, are already sensing the ominous approach of stagflation, a toxic mix of a stagnating economy and galloping prices capable of seriously undermining the dollar's position. The dominance of the U.S. dollar in global trade and the financial system is facing increasing resistance as more countries seek de-dollarization, reducing their dependence on the dollar in international transactions. Over the past month, a series of events has given new impetus to this process in the BRICS countries, Latin America, and even in some parts of Europe. Key factors include geopolitical tensions, sanctions pressure, and the desire for greater financial independence. There is a clear trend in the modern world. States are increasingly turning to alternative currencies in trade operations, concluding agreements bypassing the dollar and diversifying the reserves of their central banks, seeking to move away from the hegemony of the American currency. At the same time, political leaders openly express support for such initiatives despite warnings from experts that the dollar's position is unshakable and cannot be undermined overnight. De-dollarization, in essence, is the process of reducing the dominant role of the dollar in international trade, cross-border payments, and currency reserves. For many years, the dollar has been the key reserve currency, but its share in global central bank reserves has been steadily declining, reaching multi-year lows. Many developing countries, especially members of the BRICS group, Brazil, Russia, India, China, South Africa, and other states, See reducing dependence on the dollar as a way to protect themselves from the instability of U.S. monetary policy and potential sanctions. The events of recent years, from Western sanctions against Russia to rising interest rates in the United States, have only strengthened these countries' desire for de-dollarization. In the modern world, the BRICS countries play a leading role in the process of gradually abandoning the dollar in mutual settlements. In late February 2025, high-ranking representatives of the participating countries held a meeting at which they reaffirmed their intention to expand trade in national currencies, demonstrating resilience to pressure from the United States. According to information provided by the Brazilian Ministry of Foreign Affairs, the bloc is actively working on creating a system that will allow member countries to use their own currencies in trade operations, bypassing the use of the dollar. The Brazilian side emphasized that the country's exports to the BRICS states reached an impressive $120 billion in 2023, significantly exceeding exports to the United States and European countries, which amounted to $83 billion. Despite these impressive figures, a significant portion of trade within BRICS is still conducted in U.S. dollars. In this regard, officials see great potential for growth if it is possible to eliminate the obstacles associated with payments in the American currency. Brazilian Foreign Minister Mauro Vieira noted that trade between the BRICS countries has not yet reached its potential maximum, which emphasizes the need to stimulate trade that is not tied to the dollar. Despite rumors of a possible BRICS single currency, Brazil, which is chairing in 2025, ruled out the possibility of its immediate launch, emphasizing a gradual and thoughtful approach to de-dollarization. Behind the scenes in the Brazilian government, clarifications were made regarding President Lula's high-profile idea of creating a new reserve currency. As it turned out, this initiative never became the subject of detailed discussion by experts. Instead, the priority was given to very specific steps aimed at simplifying international settlements in national currencies. It is not about overthrowing the dollar from its pedestal, but about reasonably reducing dependence on the American currency. The BRICS summit, which will be held in July, includes ambitious projects to unite national payment systems and actively study advanced financial technologies, including blockchain. The goal of these efforts is to minimize transaction costs and speed up the settlement process. As an example, consider the Brazilian instant payment platform Pix, which is now more popular in the country than cash or bank cards. Integrating Pix with similar systems in other countries could provide instant cross-border transfers in national currencies. Such infrastructure would make trade in the currencies of the BRICS countries more convenient and efficient. It is worth noting that Brazil already has experience in successfully using a payment system in national currencies with its closest neighbors, Argentina, Uruguay, and Paraguay. This system allows for direct settlements in the South American currency RIS, bypassing the dollar. Argentina, despite its still modest scale, has already begun using its national currency in trade operations. Last year, the volume of such transactions reached 1 billion reais, which, however, is less than 10% of the country's total trade with Brazil, estimated at $27.4 billion. Nevertheless, the Argentine government expresses hope that the introduction of new technologies will significantly expand the use of national currencies in the future. Within the BRICS Association, Russia and China are most actively abandoning the dollar in mutual trade, especially after the introduction of sanctions in 2022. According to the Kremlin, by the beginning of 2024, more than 90% of trade transactions between the two countries were carried out in national currencies, mainly in yuan and rubles. In 2023, the Chinese yuan effectively displaced the dollar, becoming the most sought-after foreign currency on the Moscow exchange. The volume of deposits in yuan in Russian banks also exceeded dollar assets, which indicates a reorientation of the Russian financial system to the east. Moreover, Russia converted a significant portion of its sovereign debt from dollars and euros into yuan, increasing the volume of loans denominated in Chinese currency threefold to $46.1 billion. In an effort to mitigate the consequences of financial restrictions, Russian banks are actively integrating into the Chinese CIPS system, seeing it as an alternative to SWIFT, and are also developing their own SBFES system. These measures allow Russian and Chinese companies to conduct financial transactions bypassing Western banking infrastructure, thereby protecting transactions from the impact of sanctions aimed at dollar settlements. As a result, there is a significant increase in the use of the Chinese yuan in Russian trade operations. If before the start of the Ukrainian conflict, the share of the yuan was a negligible 1%, by 2023 it had increased to 20% of the total volume of trade settlements. The strengthening of BRICS positions also plays an important role in the process of de-dollarization. The accession of new members, including major oil exporters such as Saudi Arabia and the UAE, is seen as strengthening the diplomatic counterweight to Western influence. The expanded BRICS composition, uniting 45% of the world's population, 25% of world trade, and 31.5% of world GDP, creates favorable conditions for the development of trade bypassing the US dollar, as many participating countries already use alternative currencies in their trade operations. A picture of change is unfolding on the world stage, where Saudi Arabia, a key player in the oil market, is beginning to accept payment for its supplies to China at prices set in the United Arab Emirates. At the same time, contracts provide for the possibility of conversion into gold through the Shanghai Exchange, which is a noticeable departure from traditional settlements. Iran, another important participant in the energy market, is also actively involved in this process. In 2023, the country concluded an agreement with China according to which payment for a large-scale infrastructure project will be made in commodities, in particular oil, bypassing the use of the American dollar. Such agreements clearly demonstrate concrete steps aimed at reducing dependence on the dollar in international settlements. BRICS countries, seeking to strengthen their economic independence, are exploring the possibility of using digital currencies. The Bridge project, initiated by China, Hong Kong, the UAE, and other states, has successfully tested cross-border payments using digital currencies of central banks. As part of this project, China made a digital purchase of oil from the UAE through the UN, which became another confirmation of the viability of alternative payment systems. All these efforts are consistent with the strategic goal of BRICS to de-dollarize and move towards the use of national currencies to stimulate economic growth. BRICS leaders are actively declaring their position on the international stage. At the summit in October 2024, Xi Jinping and Vladimir Putin jointly spoke in support of creating an alternative payment system that would not depend on the American dollar, which indicates the determination of these countries to change the existing world financial order. In the corridors of world politics, the word de-dollarization is increasingly heard, and Russia is one of its main supporters, confidently declaring the inevitability of this process. According to the Russian authorities, the economic sanctions imposed by the United States only spur the abandonment of the dollar. Back in 2022, Vladimir Putin spoke of de-dollarization as an accomplished fact of Russian reality. However, there is no consensus on this issue within BRICS. India and Brazil are showing caution, not wanting to take steps that could be perceived as hostile or destabilizing. India, although it uses rupees in some trade operations, still prefers the dollar in most settlements and is in no hurry to reduce its dollar reserves. Brazilian President Lula da Silva, advocating for trade in national currencies, stressed that none of the countries intends to abandon dollar reserves or create additional difficulties. According to the BRICS Declaration, the gradual, voluntary, and non-obligatory expansion of local currency usage is occurring in parallel with existing systems. Latin American countries, particularly Brazil and Argentina, are also actively participating in the de-dollarization process, aiming to reduce their dependence on the U.S. currency through the use of alternative currencies and trade agreements that do not involve the dollar. Brazil, South America's economic giant, has taken a decisive step towards reducing its dependence on the dollar. The country has entered into an agreement with China, opening a new era in bilateral trade. Settlements will now be made in Brazilian reals and Chinese yuan, bypassing the U.S. currency. In April 2023, a historic document was signed, laying the foundation for a clearing mechanism in Brazil. This mechanism allows companies in both countries to conduct direct trade operations without the intermediation of the dollar. Given that China is Brazil's largest trading partner, with a total trade volume exceeding $150 billion annually, this move is of great significance. Eliminating the dollar from the settlement chain brings tangible benefits to businesses, reducing transaction costs and vulnerability to exchange rate fluctuations. This transition aligns with China's global strategy to strengthen its currency's position on the international stage, especially in relations with strategic partners. Brazilian President Luiz Inácio Lula da Silva openly expresses disagreement with the dominance of the dollar in the global economy. Why should every country be tied to the US dollar, he asks, emphasizing the right of states to seek alternative solutions that meet their economic interests. Argentina, experiencing severe economic turmoil and depletion of U.S. currency reserves, has turned to the yuan as a means for international payments and debt repayment. In 2023, the country's government announced a shift to paying for imports from China in yuan, which reduced the burden on currency reserves. Moreover, a currency swap agreement with China was activated, providing access to a substantial amount of 18 billion yuan provided by the Central Bank of China. By mid-2023, Argentina had conducted trade operations worth over $1 billion in Chinese currency, becoming one of the leaders in its use in Latin America. This maneuver allowed the country to bypass the dollar shortage and ensure the supply of critical goods from China. Other Latin American countries, such as Bolivia and Venezuela, are also exploring the possibility of using the yuan in trade operations, which is part of a general strategy to reduce dependence on the dollar. Some leaders of Latin American countries, including Brazilian President Lula da Silva, have put forward the idea of creating a single regional currency for South America, tentatively named SUR, which means South in Spanish. This initiative aims to reduce the continent's dependence on the US dollar in intra-regional trade and investment. Despite the fact that the idea of creating a single BRICS currency is still in the preliminary stages of negotiations, the dominant position of the dollar in world trade remains unshaken. At the same time, Brazil is taking tangible steps to strengthen financial ties within Mercosur, developing a system of settlements in national currencies which allows participating countries to do without the intermediation of the dollar. Although the volume of trade carried out in this way is still small, it marks an important precedent on the path to a gradual abandonment of the dollar in the region. The European Union has taken a more measured approach to de-dollarization. The euro, already one of the world's leading reserve currencies, is being actively promoted by European politicians and businesses as an alternative to the dollar in a number of key sectors, primarily in energy and finance. The expansion of the euro's scope in international settlements is becoming a noticeable trend, gradually displacing the dollar from trade operations. By 2024, the euro had strengthened its position, overtaking the dollar as the main currency for export operations of the European Union countries. More than half, 52% of European exports are denominated in euros, while the share of the dollar is 32%. In the field of imports, European countries continue to use the US dollar in 50% of their transactions, which is largely due to trade in energy resources. However, it is worth noting the increase in the share of settlements in euros, which reached 41% of the total volume of EU imports. This indicates a gradual but steady transition to the use of the European currency in international settlements. Europe's desire for strategic independence is driving efforts to abandon the dollar in energy trade. Following the imposition of sanctions by the United States against Iran and Russia, European countries are actively seeking alternative mechanisms for conducting trade that do not rely on the dominant role of the dollar in the SWIFT system. In 2019, Germany, France, and the United Kingdom undertook a joint effort to create Instex, a special-purpose vehicle designed to facilitate trade between European companies and Iran in euros and other local currencies, bypassing the US dollar. Despite its limited use, Instex demonstrated Europe's willingness to create alternative financial systems independent of the United States. After the start of the Russo-Ukrainian conflict in 2022, European gas importers faced a demand from Moscow to pay for Russian gas in rubles. Although this arrangement eventually lost its relevance as Europe's dependence on Russian energy declined, it demonstrated the ability of European countries to adapt to settlements in currencies other than the dollar when necessary. A new trend has emerged in economic relations between Europe and China. European companies are increasingly using the Chinese yuan in payments for energy resources. A landmark event was the deal between France's Total Energies and China's Sinopec in early 2023, when, for the first time in history, a payment for a shipment of liquefied natural gas was made in yuan. Shortly thereafter, France's Engie also concluded a similar deal with Chinese partners. These examples demonstrate that European businesses are gradually becoming accustomed to conducting financial transactions in currencies other than the US dollar, especially when it comes to cooperation with China. In parallel with this, the European Central Bank is also demonstrating a growing interest in the yuan, increasing its reserves in this currency. In doing so, it joins a small but growing group of European central banks seeking to diversify their currency portfolios. This concludes the overview of current events.